All right, so this is our last lecture on investments. Hopefully, we can get all the way through this, but we're now looking at equity investments where there is significant influence, and we're going to use that thing called equity method. And again, when we're using like the equity method after the initial purchase, we really are focused on the change in the book value of the shares, and we're not focused anymore on the change in the market value. So. Um, Again, so we're not related to the fair value at all. There are some adjustments we've got to take into account. One is changes in the book value. When we say book value, really what we mean is the value of the retained earnings of the investee. And so, what are the things that are going to affect that? One is changes in net income, net loss. And so, when the investee reports income, I, as the investor, am going to proportionately report income as well. And then we think about dividends. Dividends affect the retained earnings of the investee. They reduce them. And so from the investor's perspective, of course, that means that retained earnings, my proportion is also being reduced. And then a new one that I didn't do a lot in class, but we will cover it here in this lecture is there are some adjustments for some other items that you should also account for. And so we'll walk through that example. But there's a couple of things just sort of conceptually we need to kind of get our arms wrapped around to understand why we're doing what we're doing with the equity method. So first of all, the idea is if I'm investing in this investee and I hold 20 to 50% of the shares, I'm holding them for a reason. So in other words, I'm not trying to actively trade. I'm not trying to see some short-term gain or something like that. I'm holding them because I want to influence that investee to probably some strategic benefit to myself. And so really the value of that investment really is the production of earnings. And what that production of earnings means is that that increases the ability of the company to pay dividends. So in other words, if I hold this investment and retain my influence and then also am able to extract money out of there, in other words, get a dividend, then that's going to increase the value to me. And so we really do focus on net income and dividends and basically changes to retained earnings because that is the value to the holder is are we increasing the ability to pay dividends? And so, as the investee records income, that increases the book value of those shares. And so that's when I'm going to recognize income because their ability to pay a dividend has changed. Um, Now, interestingly, dividends, when they are paid, again, that reduces the retained earnings, it reduces the book value of those shares, but in return, I'm getting cash. And so it's really a one-to-one just exchange of one asset for another asset. So the value of my equity investment goes down, but I have cash in my pocket. So imagine that before the dividend, there's $20 per share of value in this investment. So right at that point in time, all of the value is in the investment itself. And so now if all of a sudden, let's say they pay $1 per share dividend, well, the value of that $20 drops to 19, but now I've got $1 in cash. And so the total value to me is still 20. It's just 19 is in the investment and $1 is in my pocket. And so that's why basically there's no income when the investee pays a dividend. It's just an exchange of assets. So again, hopefully that makes sense. But you can rewatch it a couple times or ask me a question in class. So looking at this, this extra information we really didn't cover in class, but here we're going to be a little more precise and use it. But basically, when we acquire the business initially, the reality is I'm acquiring the market value, but that also includes the fair value of all of their identifiable assets. But if I look at the investee's books, the only thing we're going to see is the original book value. And the reality is we know things like land and equipment and building, like things like that, the value of those can change over time in terms of their actual fair value. And so if we're trying to kind of capture this difference between fair value, book value, whatever it is, if we're going to focus on book value, given that I initially purchased things at a fair value, I need to kind of change my starting point. And so that's really what I'm doing. So internally, I would keep track of the fair value of the intangible assets that I'm acquiring. And so that's what this column. So this would be an internal process. You would use their subjective judgment to assign these values. And then we're going to use those values later on for our journal entries. And so when we think about this overall, is that if I pay $3.5 million for 40% of this company, that means the overall value of this company is $8.75 million. Now we have $4.1 million in identifiable assets. So internally, what we really conclude is that there's about 4.65 million in goodwill in this company. Again, this is all implied. This is all internal. We are not doing anything with this information explicitly, but we will use this information later on. And so all that said, the initial journal entry is very, very simple. All we do is identify how much we paid for that equity investment and assign it to the equity investment account. So a very straightforward transaction. So cash is credited, that's how much we paid, and we debit the equity investment for that 3.5 million. And again, separately, we're keeping track of these identifiable assets, but we're not doing it explicitly in any sort of journal entry. And so then when Carolina, who's the investee, when that company reports net income, the book value is going to increase. And so, if the income is $950,000, that means that 40% of that income as a proportional shareholder belongs to me. And so in total, then the increase in value from my perspective in the investment is an increase of $380,000. So that's going to increase the value of the equity investment. And in this case, whenever the investee reports net income, I will report investment revenue at that point in time. Because again, their ability to pay a dividend went up. And so that increases the value. That's income to me. And so if there had been a loss, then we just flip this. The equity investment would be a credit, and the investment revenue would be like probably some loss account or something like that. We'd probably still use the same account name, just it would be reported as a negative. So dividend payments, we kind of previewed this already. But again, the idea here is when a dividend is paid, the book value, again, the retained earnings of that investee are going to decrease. And so if they pay a $75,000 dividend, this is just for example, 40% of that dividend is mine. And so I would reduce the value of that investment by the $30,000, but of course I'm receiving $30,000 in cash. And so there's no income here, just I'm exchanging one asset for another. And again, this is one we did in class. Hopefully it's not too bad. But again, the key idea here is that we're just exchanging assets. We're not recording income under the equity method when there's a dividend payment. This is what we didn't do in class, but I'm going to go over it here. And so the whole idea with this, like broad takeaway, is that we're going to make some simplifying assumptions, but the idea is that the investee is depreciating all of their identifiable or the depreciable assets. And so we're just going to assume, kind of straightforward that, they're depreciating the equipment at $125,000 per year. They're depreciating the building, $42,500 per year. Again, this is just information that would be given to you as far as the amount of years of depreciation left and things like that. And so their actual depreciation is whatever that total is 167,500. But 40% of that depreciation would have been proportionally in the income that I recorded as my investment revenue, right? So that depreciation would have affected their net income. Since that in net income affected my investment income, it means that my investment income is related to the depreciation of the investee's identifiable assets. But we also know that internally, we carried those assets at a different value internally. And so we had assigned a fair value of the equipment of 400,000. We had assigned a different value to the building of 1.1 million. We depreciate them over the same useful life, but that results in a slightly different total depreciation amount. And so internally, really in my mind, my real depreciation, instead of 67,000 a year, my depreciation was really $62,000 a year. What does that mean? Well, that means that the net income that was reported by the investee does not accurately reflect the change in value from my perspective. And so basically there's $67,000 too much depreciation, which means net income is kind of understated. And so there's a $5,000 difference, right? There's too much depreciation, again, from my internal perspective. And so that $5,000 difference, I'm going to account for that difference now as sort of a final step in handling this equity method or this significant influence investment. So what does that mean? So given that $5,000 difference, what does that mean? It means that the equity investment balance is understated. It means that there's really $5,000 of additional value on that investment, and that the net income incorrectly captured given the difference in the fair value compared to the book value of those identifiable assets. And so what are we going to do? Well, we're going to increase the equity investment by $5,000. That is going to be offset by a credit to investment revenue. And so this basically reconciles those two accounts given any difference in internal depreciation versus the investee's depreciation. And so once we have that information, the journal entry honestly is not that hard, but we do need to make that final adjustment. Again, not every company will have this, and so it's not a journal entry you're going to see every day, but hopefully that helped you walk through it a little bit. So then finally, we take that information and we put the information on our financial statements, and of course, we have that equity investment. There's two things going on an account in 2025. First of all, the initial acquisition, and then we did have all of those entries to the equity investment account, and there were two of them, or sorry, three of them. So we have, of course, we have the 3.5 million, the original cost. We have the net income. We have the dividend, and we have that adjustment from the depreciation. So those three things are what's going to change the value of our equity investment so that by the end of the year, the value of our equity investment is just over $3.8 million. And then on the income statement side, there's that investment revenue account. In this case, there are only two journal entries. So there was the net income, and then there was the depreciation adjustment. And so together, our income, our revenue from that item was $385,000. And again, just noting the dividend, there's no impact on investment revenue from the dividend because the dividend is offset by the cash receipt. So a couple other things. This is our last slide. Some other things regarding equity investments using the equity method. First of all, if for whatever reason you were to acquire something partway through the year, which is common, you would basically, proportionally allocate or proportionally record net income just for the period in which you held it, not for the entire year. You can have an impairment. In other words, you are carrying that value at a book value, and basically, if you assess that the market value is significantly and permanently below that book value, then you would mark it down and impair it. You might internally also impair those assets potentially as well. So it'd be a pretty involved process. You are allowed to change methods. We're not going to really walk through that, but basically, if you do, you're going to recognize some gains. And so just understand that. If an equity method, if it's sold, then you would probably have a gain or a loss there because the cash that you're going to receive is going to be different than the book value of that investment. And so hopefully it's obvious by this point in the chapter that you would have to recognize some sort of gain or loss, given that there'd be a difference there. And then finally, you can have a separate fair value adjustment if you want. It is permissible, but you do need to disclose that you're doing that. Most companies wouldn't, but just so you know, that is an option. You could carry that fair value adjustment separately if you wanted to. All right, I think that's it, and hopefully that lands the plane. And once we get through the next chapter, we'll get another set of recordings out there.